Hi, in today's video, we're going to be covering a very important technical indicator that is popular for its ability to provide information on trend reversals and the strength and direction of a trend. It is known as the MACD, or Moving Average Convergence Divergence. Gerald Apple developed the MACD in the late 1970s to visualize the relationship between two exponential moving averages of an asset's price. With a MACD chart, you will often see three different lines used in its settings. So the first is the number of periods used to calculate the faster moving average, which is usually the 12 EMA. The second is the number of periods used in the slower moving average, and this is usually the 26 EMA. And the third is the number of bars used to calculate the moving average of the difference between the faster and slower moving averages, and this is the 9 EMA. There's often a misconception about the MACD or MACD, and that is that they are just simply two moving averages that cross over, but it is actually quite different from that. The first line is known as the MACD line, as you can see at the bottom of the chart, and the second line is known as the signal line. These two lines are not moving averages of the price. The MACD line is the difference or distance between the two moving averages, and these two moving averages are usually exponential moving averages. So when you look at the chart, the MACD line is the faster moving line. In other words, it's more responsive to the market movements. The signal line is actually the slower moving average or slower moving line, so it responds a little bit slower to the market movements than the MACD line does. The purpose of the signal line is to smooth out the sensitivity of the MACD line. And the histogram that you can see below is simply the difference between the signal line and the MACD line. It is a graphical representation of the distance between the two lines. And what the histogram does is it may give you an early signal that a crossover is about to happen. As the MACD and signal line get closer together, the histogram gets smaller. This is called convergence because the MACD line is converging or getting closer to the slower moving average or the signal line. So how do you use the MACD? Well, there are three different strategies that most traders use. The first is signal line crossovers, and this is probably the most popular strategy. So the signals come from the signal line crossovers. When the MACD line crosses above the signal line, we get a bullish signal, suggesting that it may be a good time to buy. Conversely, when the MACD line crosses below the signal line, you get a bearish signal, indicating it might be a good time to sell. So when using MACD crossovers, it's very important to consider other factors like the overall trend, various support and resistance levels, and other technical indicators to ensure that you have confirmation on when it's a good idea to exit or enter a trade. The second way that traders use the MACD line is with a strategy known as divergence. So divergence between the price of an asset and the MACD can often signal an upcoming price reversal. So if the asset's price is making higher highs while the MACD line is making lower highs, this bearish divergence could be a sign of a possible downtrend. And if the price is making lower lows while the MACD line is making higher lows, this bullish divergence could signal an upcoming uptrend. For divergences, you can use them as early warning signs of potential reversals, but it's very important that you do wait for a confirmation. A divergence doesn't always lead to an immediate reversal, and it could take some time before the price changes direction. Thirdly, many traders use the MACD as an indicator of oversold or overbought conditions, but this is not how it's usually used. So a dramatic rise in the MACD line could mean that the asset's price is overextended and will soon return to normal levels. And a sharp fall in the MACD line might suggest that the asset is oversold and due for a price increase. But if you are going to use the MACD to identify overbought and oversold conditions, you should use other oscillators like the relative strength index for confirmation. So like with any indicator, the MACD has both its strengths and its weaknesses. Firstly, it's very simple to use, and it provides very clear signals. It also can be used across multiple time frames, and it can be used with many different assets, including forex, commodities, indices, and cryptocurrencies. In terms of disadvantages, because it's a lagging indicator, it is based on historical data, which means that it might produce false signals. As a practical tip, the MACD is only one part of your trading strategy. You should confirm your entries and exits with other technical indicators, consider the fundamental analysis surrounding the market you're looking at, and ensure that you use good risk management and consider the market sentiment. Thanks for watching. If you have any questions regarding the MACD or any other technical indicator or trading related question, please get hold of us at FxScouts.com, and please remember to subscribe and like. Cheers.